What's up, folks? So about half of you did not have me for AIS, and I know I've said that phrase a lot. You're going to hear me say it a lot more. So if you're getting tired of it, buckle up. That's all I can tell you. But the reason I mention that is that you're going to hear one of these things come up about midweek every single week. You're going to talk about my disdain for Wednesdays. And those of you who did have me in AIS are like nodding. It's like, yeah, you talked about it all the time in AIS. So just as a context, I think Wednesday is the worst day of the week, and I have a very strong reason for it, a very strong prerogative, because it's basically the furthest point between two weekends. And it kind of seems, and maybe it's a self-fulfilling prophecy, but it seems like whenever I have something bad goes on, I'm just kind of like, go to Wednesday. I haven't anything particularly bad happen today, but maybe I'm just setting myself up for failure after class. I don't know. I don't know. What are your perspectives? Do you have any days of the week that you like least? I mean, usually it's Monday. Is everybody kind of on board with Monday?
I don't like Thursday.
Like Thursday?
No,
What's your logic for Thursday?
I want it to be Friday and it's not.
Yeah.
And everything seems to stack up before I get all my homework due
Yeah,
Thursday.
that makes sense. That makes sense. I can respect that. I don't know. My perspective has only come since I've kind of gotten like a 9 to 5, 5 days a week job. When I started back at KPMG, that was kind of my perspective. I was like, I really would like to have off on Wednesdays. Not that I wanted to work on weekends, but I also wanted to have on Wednesdays. Let's just be honest. If we could have every day of the week off, that would be where we want to be. But it's not the society we live in. I don't know. I talked to my mom and she's retired and she just gets bored now. She talks about how bored she is. And I said, oh, poor you. Yeah. So all right. So that's me ranting. This is me apologizing because I said something very confusing on Monday. So the problem is as I get older, I do crazy things. You all have already heard my email address from when I was much younger, and that was embarrassing. But now I've got to admit something even worse embarrassing because I was talking about the activity that we'll be doing for chapter 4. That doesn't take place until this coming Monday, not on Friday. So Friday, we're going to be starting chapter 4, and then we'll do the wrap-up activity on Monday. So if anybody was confused about that, I apologize for your confusion. I'm 54 years old, going on 55, and I live in a perpetual state of confusion. So yeah, that's just kind of what it is. So get ready, get ready. Yeah, I get really, really annoyed when some of my local friends around here talk about how they just feel like they're getting older, and they're still in their mid 30s, and I'm just like, just shut up, shut up. You know, you're not old, you're still young, you're still young. I feel it more and more every day, more and more every day. Today we have chapter 3 homework that we're going to be talking about, and hopefully, fingers crossed, I don't Wednesday it up today. I don't Wednesday it up. We'll see what happens. So the stuff that we're going to be talking about with respect to multiple choice is pretty good. I do think that these are some strong multiple choice questions. So hopefully you took diligent notes on what your answers were on this, and you take diligent notes as we go through this. So let's start out with 317. Before accepting an audit engagement, a successor auditor should make specific inquiries of the predecessor auditor regarding the predecessor's what? So make sure that we have clear understanding of this terminology. We're talking about the successor auditor. This is the person who's taking over the audit engagement. This is generally going to be our perspective. We're joining the audit for the first time. Now, when we talk about predecessor auditor, this is assuming that the audit has taken place previously. So somebody has audited this organization previously. Now, the great news about having a predecessor auditor is if they are willing to cooperate with us, they can give us valuable information with respect to the engagement itself. But there are some things that we would like to know very specifically about. What are some of those things? Well, the most important things that we can talk about are listed in the slides. And if you remember, the very last one that I listed was, why is the client looking for a new auditor? Why is the client looking for a new auditor? And I gave an explanation for that. I said it's not necessarily nefarious. It's not like the client is an evil villain with a twisty mustache saying, I'm trying to get away with fraud. I'm sorry, guys. Anyway, so that's not necessarily the reason. There may be a legitimate reason, such as the client has outgrown the existing audit engagement. So it goes to the existing auditor. So we need to make sure we have that clear understanding. And that's given as one of the answers. It's D here. Understanding is the reason for the change of auditors. So keep in mind that we do need to have that communication, and there's some very important details. Some of those details, such as the understanding for change of auditors, are required communication that we would have with the predecessor auditor. All right, 318. A written understanding between the auditors and the entity concerning the auditor's responsibility for fraud is usually set forth in a what? Well, we only talked about one of these letters so far, so it's probably the answer. This is a good example of understanding what phase of the audit you're in. That's going to be something that's going to come up a couple of times in these multiple choice questions, is understanding the phase of the audit. Well, we're so new in the semester. We're at the beginning of the semester. We've only talked about one phase of the audit. That's the planning phase. What's the only document we've talked about? The engagement letter, which is a contract set forth between the auditor and the client. Now, I can't just leave it at that. I would not be doing justice, but what is the engagement letter? It talks about three things very, very specifically, which I talked about in class. I said, take notes on this because this is not in the slides. That is the objectives of the audit, the management's responsibility, and the auditor's responsibility. I also talked about the difference between management's responsibility and auditor's responsibility. Does everybody remember that discussion? Saying management's responsibility is for the creation of financial statements and internal controls. Auditor's responsibility is for the evaluation of financial statements and internal controls. So a lot going on in that question, even if you didn't realize it, all that stuff being very relevant. 319. The independent auditors decided it is sufficient to consider how work performed by the internal auditors may affect the nature, timing, and extent of audit procedures. They should assess the internal auditors what? So there were three things that we talked about. Let's talk about the first two. What were the first two that we talked about? Objectivity and competence. Okay, the objectivity and competence, which are the two that are given up there for answer A. But it wouldn't be complete if we didn't talk about the other one. What do we say the third one is that's only going to be used sometimes?
Systematic and disciplined approach.
Yeah, systematic and disciplined approach. Now, this again, the reason I mentioned this is I explained this when we talked about it in class. I said when we talk about one set of standards, it's only the first two, objectivity and competence. If we talk about public company auditing standards, it's going to be all three. So which one am I going to expect you to remember? The easy one or the hard one? The hard one. Yeah, you can guess that one. If it's going to be a harder option, I'm probably going to go with that one. So you do need to remember all three. It's not really that difficult. You have to remember three things instead of two. So I have confidence in your ability to remember three things instead of two. So keep that in mind. All right. Moving on, question 320. During the initial planning phase of audit, a CPA most likely would do what? So this is emblematic of something that we need to talk about with respect to this course. You're going to see these questions pop up a lot. These are called phase questions, specifically phase of the audit questions. If I specify a phase of the audit, you need to make sure that you identify what occurs during each phase. So this specifically talks about the planning phase of audit. The good news is we haven't talked about all these things up here. We've only talked about some of them. So let's go ahead and talk about the things that we've had discussed. Have we discussed how to identify specific internal control activities that are likely to prevent fraud? Now, let me preface that by saying, have we talked about it in this course? Not yet, not yet. Is that an important point of auditor's responsibility? Yes. In fact, we're going to get a lot more in detail on that in the next few chapters, all right? So it's really important. It's a core concept of this course, but we've not gone into detail about how we actually do that in this context yet. All right. Have we evaluated the reasonableness of the entity's accounting estimates? That sure sounds like collecting evidence, doesn't it? Have we talked about collecting evidence? We talked a little bit about it in chapter 1, but does anybody know that process yet? I think probably only one person in the room, maybe multiple people if you've done an audit internship, but for the most part, we've not talked about this, okay? So we can say that's probably not it. And we talk about it, collecting evidence that kind of takes place during the test of controls and the substantive procedures phases. So again, two things that are not within the planning phase. Discuss the timing of audit procedures with entities management. All right, have we talked about that yet? Yes, we absolutely did. That was one of the things that's part of the audit strategy and plan, okay? And that is in fact why that's our answer, but let's look at D just in case. Inquire the entity's attorney if it's probable that any unrecorded claims will be asserted. So make a note of this because this will come up multiple times over the course of the semester. When we see inquire of the entity's attorney, that's something that takes place at the tail end of the audit, at the very end of the audit, before we issue our opinion. And the reason I mention this is we'll see a lot of questions like this where this is one of the options. In fact, this is usually answer D in most of those situations. Inquiry of the client's attorney. This is a conclusion procedure, a concluding procedure. So C is our answer. All right, going on to question 21. As generally conceived, the audit committee of a publicly held company should be made up of what? All right, so we talked about a couple of different standards under the Sarbanes-Oxley Act of 2002. Everybody read the Sarbanes-Oxley Act now that I gave you access to it? Good job. Thank you for nodding your heads, even if it's a pity nod, okay? Yeah, now that you have access to the Sarbanes-Oxley Act, but there's two specific areas we talked about. So I believe it was section 301 and section 406. My numbers could be off, but I'm not going to test you on what the section numbers are. I am going to test you on what those section numbers contain. So the first one talked about something called outside independent board members. It's outside independent board members. Which of these answers listed up here best represents the characteristics of outside independent board members? D, members of the board of directors who are not officers or employees. Very good. So D is our answer to this one. But let's go ahead and talk about this. What was the other criteria that we had to have for audit committees? This is not specifically talked about in the question, but it's a criteria you do need to know. There has to be at least one financial expert on the audit committee, and financial expertise is defined by somebody who's got expertise with the use of generally accepted accounting principles and generally accepted auditing standards and engagement of an audit, usually a controller, a CFO who's managed an audit engagement or been part of an audit engagement. All right. Yeah. So 322. When planning an audit, an auditor should do what? Okay, another phase question. So let's go ahead and answer these questions. So consider whether the extent of substantive procedures may be reduced based on the test of controls. So is this something that comes up during an audit? Yes. But you see that term substantive procedures, okay? When do substantive procedures occur? We talked about the sequence of the audit. Does that occur near the beginning or near the end of the audit? Closer to the end. That's when we're gathering evidence. That usually takes place after test of controls. This statement will make sense when we get to chapter 4 about what this characterizes, but it makes no sense right now. At least it shouldn't. If it makes perfect sense to you, then I've done a better job of teaching than I actually thought. But yeah, presumably that statement makes no sense to you right now because we've not talked about any of the other phases of the audit. Determine overall materiality for audit purposes. Have we done that? Yes, we have. That was the latter part of chapter 3. So that's our answer, but let's go through the rest. Include where the changes in compliance with prescribed internal controls justify reliance in them. We've not really talked about what our responsibilities are with internal controls. We've not done test of controls, so that's not going to be an answer. Evaluate detected misstatements. If we're going to evaluate detected misstatements, doesn't that imply that we have to have detected misstatements? Yes, that implies that we've done some testing and we've not gotten to any of the testing phases yet. So we can't evaluate detected misstatements because we've not actually identified any. So B is our only answer. Let's move on to 325. Tolerable misstatement is what? Okay, so tolerable misstatement, let's contrast that to planning materiality. What did I say planning materiality is? It's also called overall materiality, and it's materiality for the entire audit as a whole, for the financial statements as a whole. So planning materiality is our big picture. This is what the misstatement that we're trying to avoid for the financial statements as a whole. We establish planning materiality so that we can determine tolerable misstatement, which is misstatements at the account or disclosure level. Generally speaking, for our purposes, we're just going to limit it to accounts because we're not going to evaluate misstatements of our disclosures. So you can just think about it as tolerable misstatement is at the account level. So which answer is best consistent with that? Materiality used to establish the scope for the audit procedures for individual account balances or disclosures. D. Okay, D. By the way, let's go ahead and review some information. This is going to be relevant to what we're going to be talking about in a second. There were 2 rules I talked about with tolerable misstatement that were really important. So the maximum amount of tolerable misstatement I can assign to any one account is going to fall between a certain range. What was that range?
50 and 75%.
50 and 75%. Once we establish that amount, that is the maximum amount we can assign to any one account. We'll set that amount. That's not saying every single amount must be between 50 and 75%. It's saying this is the maximum amount. Once that number is established, that is our scope. That is our scope. All right. Second one, as I said, that we can aggregate all of our total tolerable misstatements that we assign, and it should be no more than what range? 3 to 4 times tolerable misstatement, or planning materiality. 3 to 4 times planning materiality. My apologies. We're going to see that application when we get to our final activity today. All right, last multiple choice question. Which of the following would an auditor most likely use in determining overall materiality when planning the audit? By the way, does anybody hate questions that use those words most likely? It's like there could be more than one answer. We're looking for the best answer. If you really, really hate those questions, I got bad news for you. Those are all over the CPA exam, especially the audit section of the CPA exam. And now people are saying, I am second guessing becoming a CPA. Yeah. Well, the good news is that it becomes easier to answer those questions once you get some more exposure to them. The bad news is this course is chock full of questions like that. So which one's going to be the most likely one that we're going to consider as far as planning the audit? All right. Well, let's just go through these. Anticipated sample size of planned substantive tests. So could a sample size have an effect on materiality? Yes, but usually that's going to be about what the materiality amount should be. Okay. So actually, sorry, it shouldn't be the other way around. Materiality will generally dictate sample size, not the other way around. Entity's income before taxes before the period to date. So it could be like 6 months, it could be a year. Does that sound like something that would establish a quantitative base for us? Yes, that was our prime example. That was the one that we talked about in class. So this is our answer. But let's go ahead and look at the rest. The results of test of controls. So we established materiality during the planning phase, which planning phase takes place before test of controls. So results of test of controls by logic can't actually determine what our materiality is, okay, or determine overall materiality. The contents of the engagement letter. This is a tricky one because this can take place before we establish materiality. But did we talk about any conceptual linkage between these two concepts? Did I say when we got to the engagement letter, it says, we use this for establishing materiality? Did those words come out of my mouth? I mean, they just did now, but did they come out of my mouth when we talked about this last week? No. The engagement letter is a separate concept from materiality. Now, could it have some effect on materiality? Maybe to some degree, but it's definitely not going to be the most likely effect of materiality. Okay. That's why they use the word most likely there, because we're talking about something that's going to have a very profound effect, which is going to be the income before taxes. All right, let's go ahead and look at our problem. All right, for each of the following scenarios, we're going to perform 3 steps in the materiality process. We're going to determine overall materiality, we're going to determine tolerable misstatement, and evaluate the audit findings. Now, I do want to clarify this a little bit because this is a little bit of a misnomer. And again, this goes back to something I talked about with the book being a little bit non-specific in certain areas. And again, I think I explained this already, but part of the reason for this is the people who do the editing for the book are not auditors. The people who wrote the book are audit instructors, and they do a really nice job. People who update the text, they're editors, okay? They've got experience in other areas, so their knowledge in auditing is a little bit non-specific, and so they make mistakes, even though I whine like a baby sometimes about how many mistakes they make. They really don't take me very seriously anymore, which I guess if you cry wolf enough times, then people are just going to ignore you. But I kind of given up on that. Anyway, the reason I mention this is that determining tolerable misstatement is not an accurate portrayal of this. Determining tolerable misstatement would be different for every single account. So what we should be using is saying determining the maximum amount of tolerable misstatement that can be assigned. So you should read this and say, this is not actually tolerable misstatement for each account. This is saying, what is the maximum amount that any one account could contain? All right, that's how you should read this. Scenario 1. Murphy & Johnson is a privately owned for-profit manufacturer of small motors from lawnmowers, tractors, and snowmobiles. The components of the financial statements are, and listed below. So what's overall materiality? So overall materiality, what is our general guideline for materiality, or for determining planning materiality?
5% of income before tax.
5% of income before taxes. Do you think income before taxes is an appropriate quantitative base in this scenario?
Yeah.
I would say. That's right. It's a for-profit company. So I would say that's fine. We don't have any reason to justify any change in 5%. So I think 5% of income before taxes makes perfect sense in this scenario. So let's just go ahead and say that the 5% of income before taxes, which would be 21 million. Is everybody good with that one? Roughly $21 million. Okay. So actually, no, that's income before taxes, 21 million. So then what is the income? What is the materiality? I'm looking at the wrong number. So overall materiality would be 1.05 million. Is that correct? Okay. So then determining tolerable misstatement, again, maximum tolerable misstatement that can be assigned to any account. It really depends on what you set as a percentage. You could use 50%, you could use 75%, you could use some percentage in there. For mathematical purposes, I'm just going to use 50% because it's easier to calculate. Now, if you use 75%, I don't think your answer will change here. Either one of those is fine and would be a correct answer on the exam if I asked a question like this. All right. So don't panic if you say, I used a different percentage. I'm so bad. No, you're fine. Okay. But 50% of 1.05 million would be $525,000. Okay. Be slightly more than that, be in the $750,000 range if you use 75%, or somewhere in that range if you use a different percentage. I got to imagine someday I'm going to get a student in my class who's just going to say, I'm going to use 67% for every single one of these because 6, 7, never mind. Never mind. That was terrible. That's terrible. Anyway, yeah. So $525,000. Let's look at the question here. So over the course of the audit, Murphy's and Johnson CPA firm detected 2 misstatements that aggregated to an overstatement of 1.25 million. Evaluate the audit findings and justify your decision. So what do we mean by evaluate the audit findings? Very simple question. are the financial statements free from material misstatements? What do you guys think in this particular scenario? They are not free from material misstatement because we have actual misstatements or detected misstatements, which I called actual misstatements when we talked about it on Monday. Said detected misstatements of 1.25 million. We said that our planning materiality is 1.05 million. So the amount that we detected is greater than the amount that we can tolerate. All right. Now, logically speaking, if we can only tolerate 1.05 million, if we have an amount greater than that, then there's a problem. So in this situation, we're going to say the financial statements are not free from material misstatement. So that leads us to a couple of scenarios. The first scenario is we're going to go to their client, and this is the best scenario. We go to the client and say, we need you to make an adjustment to your financial statements so they're no longer materially misstated. And if the client says, all right, that sounds good, then we're in great shape. We can go ahead and move on with the audit and move on with our lives. What happens if the audit client says, we refuse to make an adjustment, we think our financial statements are correct? That's where we have a problem. That's where we generally are going to issue that opinion that we talked about back in chapter 1, where we're going to say there is a problem, whether this represents a qualified opinion or an adverse opinion, either one, because the financial statements are materially misstated. All right, let's move on to scenario 2. Delta Investments provides a group of mutual funds for investors. The components of the financial statements are listed, determine overall materiality, and determine tolerable statements. So let's just go ahead and use our rule of thumb again. Would it make sense for us to use income before taxes in this scenario? No, because remember, I threw out a couple of caveats to you on materiality on Monday. I said there's 2 scenarios where you would not use income before taxes. One of those was not for profit. The other one was asset-based entities, which is an example of a mutual fund. And it makes sense because if you look at income before taxes and then total assets, look at the delta here. Look at the difference between these. One is 40 million, one is 4.3 billion. One is 4.3 billion. So is that going to lead to a lot of difference if we use a lower amount? So if I use 5% of income before taxes, I don't even know at the top of my head, that's like $200,000. No, maybe it's more than that. 2 million. $2 million. Okay. So $2 million. What if I use, what did I say here? So what if I use 0.5% of total assets, which I'm going on a very, very small amount here. So 0.5%. If we could use 1%, 1% is probably more reasonable. What if I use 0.5%? What's 0.5% of total assets? 21.5 million. So ask yourself, you're an auditor. I could set materiality at 21.5 million, or I could set it at 2 million. Which would you prefer? 21.5 million. Because the larger materiality is, the less work we have to do to find small misstatements. Okay, we have a larger scope of materiality, and it gives us a much more broad area. So that's why we're trying to use a much larger number. That's why we're justifying this larger number. And I think it makes sense because total assets are so large. All right, what's tolerable misstatement? Tolerable misstatement would roughly be half of that. If you used 1%, then half of that would be 21.5 million. If you used 0.5% of total assets, then it would be 10.75 million. Honestly irrelevant because once we go down here, they detect 2 misstatements, an aggregate overstatement of 5.75 million. That is less than any of these amounts that we use for tolerable or for planning materiality purposes. Remember, we said planning materiality at a very, very conservative level was 21.5 million. This is far less than 21.5 million. Now let's assume that you used income before taxes. Did your answer change if you use income before taxes? Yes. Okay. And then that means we got a material misstatement, and we go to our client and say that, and they say, what? It's only $6 million. I don't understand the problem here. We're a $4 billion company. I don't see what the issue is here. And you'd be like, you're crazy. 1 million or $2 million is enough of a misstatement. So that's why the materiality determination is so critical in understanding why we would use a different quantitative base here. All right. Scenario 3, Swell Computers is a public company that manufactures desktop and laptop computers. Their financial statement components are listed below. Overall materiality. So this is kind of a tricky one. This is a tricky one. So let's ignore the numbers right now. Would income before taxes, would that be an appropriate base, ignoring the numbers? Well, they're a publicly traded company and they're profit oriented. So that would make sense if we ignore the numbers. But the numbers seem to be relevant here. Why are the numbers a problem?
Because the income before taxes is so drastically different from the other two numbers.
Yeah, it is a small number. They've got total assets of 2.2 billion and 7 billion. Their income before taxes is basically zero. I say basically zero. It's 500,000. Yes.
It also says that the public company that does a lot of manufactures a lot of product. So would that make them an asset-based company as well?
Probably not, because we assume that they're in the market of exchanging whatever they manufacture for sale. So it's not an investment company like an asset that holds assets for long periods of time and tries to gain off those. So I think this is more of a for-profit entity. So if this number was more reasonable, like this, if this was like 60 million or something like that, then I might say that this is more reasonable. But 500,000, that's basically nothing for a company that's $7 billion in revenues. All right. So this is where we run into a problem where we have to say we got to use something other than the base. Because if we use 5% of income before taxes, what is 5% of 500,000? $25,000. All right. If somebody put me on a $7 billion company and said you had to find all misstatements of $25,000, it'd be like, that's it. I'm going to education, which I did. So you can see what happened there. All right. So anyway, yeah, I'd be leaving. So what would we use? Let's go ahead and say we're going to use 0.5% of total assets again. Use that same number we used before. So we could say the number that we're going to use for materiality is going to be $11 million, which is, again, 0.5% of this 2.2 billion. So $11 million. Now, again, if you're an auditor, would you rather use $25,000 as your materiality or $11 million? We can separate the class, and I'm going to give you a whole bunch of misstatements. Those of you who are going to have to find everything below $11 million, you're going to have a very easy workload. Those of you for everything below $25,000 are going to be working on nothing but this class for the rest of the semester. Which one of those things sounds more appealing? I want to be in the first group, Dr. Barnes. Everybody's afraid to answer. Afraid. Would he really do that? No, I wouldn't. I would never. Maybe hardly ever. Anyway, so $11 million. Tolerable statement, maximum tolerable statement is 50% of that, so $5.5 million. Let's go ahead and take a look at the question here. So during the course of the audit, small CPA firm detected one misstatement that resulted in overstatement of income by $1.5 million. Now, this is a trick. This is a trick question, and I will admit this trick question. So the first thing you could say is that, well, materiality is $11 million. This is far less than materiality. So $1.5 million is not enough to make a misstatement. And I would agree with you, except for one problem, one circumstance. And that the key here is it says overstatement of income. What happens if this is an overstatement of income? If the client has deliberately overstated their income by 1.5 million? Yeah, they go from being in a profitable position to a loss position. And remember, we talked about that as one of the qualitative criteria. If that was something, if small changes in income would change them from profit to loss, we do have to consider using a different basis, different evaluation protocol. So this is kind of a reflection of what we talked about before. So this might be a situation where I'd say, look, this is not materially misstated, but I do think you should make an adjustment here because that $1.5 million directly affects your income. This is one of those rare scenarios where it's not going to be material within context of the quantitative amount, but it would be material with respect to the income that they're representing. All right, MS Designs, a for-product clothing manufacturer, components, financial statements are listed. What's overall materiality? What do you guys think? Think income before taxes would be reasonable to use here? I think 5% of pre-tax income seems pretty reasonable. These numbers are not that disparate. So 3.5 million, 5% of that would be 175,000. And then half of that for tolerable misstatement is 87,500. Okay. So pretty straightforward there. Let's look at part B. Course of the audit, they detected one misstatement in a key customer's accounts receivable equal to $90,000. They also detected a second misstatement in cash equal to $10,000. Evaluate the audit findings and justify your decisions. So this one's a little bit tricky because depending on whether you use 75% or 50%, your answer may change. If you use 75%, then you probably came up with a tolerable misstatement amount of, I would guess, somewhere around 120,000, something like that. And if you look at this misstatement that's in the key account, that's less than 125,000. So you're probably saying, I'm fine, Dr. Barnes, I'm moving on with my life. Those of you who are in the 50% park with me are going to say 90,000 is greater than 87,500. And we talked about this a little bit on Monday. Is a misstatement in the account greater than tolerable misstatement enough to trigger a required adjustment? The answer is not always. but sometimes. What would be a key indicator of where we need to make an adjustment to the client's account?
The size, complexity, activity, and risk.
Good, yeah, yeah. So how prominent this account is, size, activity, complexity, and risk. And this tells you that this is a key customer's accounts receivable, which seems to be something that's suggesting that this is a really important account for the organization. And if this is a really important account with the organization, I would say any misstatement above tolerable misstatement, we need to make an adjustment for. All right. So this is a subjective question. Is this always going to be the answer that I give you? No, which means that I probably won't ask a question like this on the exam. But it's important to consider from an audit perspective, is there may be times that we bend the rules and say, this would be a rule that we use in one situation, but we use a different criteria in this situation. I shouldn't say bend the rules. That gives the implication of fraud. This is where we'd use the rules differently in different situations. How's that? How's that? That still sounds shady, doesn't it? All right. Anyway, yeah, I'm not trying to encourage you all to do shady behavior. That's not my goal here. All right. Discussion. So Forest Crest Woolen Mills is a closely held North Carolina company that has existed since 1920. The company manufactures high quality woolen cloth for men and women's outerwear. Your firm has audited Forest Crest for 15 years. 5 years ago, Forest Crest signed a consent decree with the North Carolina Environmental Protection Agency. What's this consent decree? That's what I thought. All right. So you guys have an informal assignment for the rest of your lives. All right. So when you see a piece of information that you're like, I'm not exactly sure what that is, I want you to pull it up on your phone and look it up. Okay. Am I going to require you to do that for specific things in this course? No. But do I think you should do that as a general rule of principle in life? Absolutely. I go to Wikipedia like 12 times a day to answer questions about things that I don't know about. Now, I told my graduate students earlier today, I said, usually it's looking at something that's completely irrelevant, like who was the actor that starred in this movie from the 1980s, but I'm still on the pursuit for information. So if you find something that you're not familiar with, especially words or definitions or terms like this, I strongly recommend that you get in the habit of looking those up. That will make you a better, fuller, stronger person that talks really, really fast. Yeah. So anyway, consent decree. Consent decree is an agreement, a settlement that resolves a dispute between two parties without admission of guilt or liability. So basically saying we've got a settlement here. We're not going to say that you're liable for this, but you do have a task that you have to complete in order to basically avoid prosecution in this area. The company has been convicted of dumping pollutants such as bleaching, dye, and dyeing chemicals into a local river. The consent decree provided that Forest Crest construct a water treatment facility within 8 years of risk being fined or even shut down. You're conducting the current year audit. In year 5, you notice that there's been virtually no activity in the water treatment facility constructed account. Your discussion with the controller produces the following comment. Because of increased competition and lower sales volume, our cash flow has decreased below normal levels. You better talk to the president about the treatment facility. So the president and majority shareholder tells you the following. Given the current cash flows, we had two choices: lay off people or stop working on the facility. This is a poor rural area of North Carolina with few other job opportunities for our people. I decided to stop working in the water treatment facility. I don't think the state will fine or close us down. When you ask the president of the company whether they will be able to comply with the consent decree, he informs you that he is uncertain. This one's one that's a little bit challenging. We haven't talked directly about this, but I think this is an interesting question. So let's just answer a very basic question. Would you, as an auditor in this position doing the planning for the 5th year audit, be troubled by this scenario? Okay, I think everybody in this room probably says, yeah, there are problems there. Otherwise, Dr. Barnes would not have assigned it. Okay, he's not trying to trick us. Yeah, there are some problems, some issues here. So there should have been work done on this moving into 8 years. They have 8 years to meet this requirements, and they've done basically nothing, which means they have 3 years to pick up this slack. The signal is that right now they don't have any plans on meeting this requirement, and so they could face fining or possibly being shut down. That's the threat. And usually when it comes to compliance and laws and regulations, regulators are pretty insistent on making sure that the rules are followed. So in this situation, what would be your responsibility? What would be your implication for the audit and audit report? The implications for the audit are not too obvious. You'd want to make sure that you see any evidence or document any evidence of progress in this area to make sure that's listed. The audit report is a little bit more subtle. So we're going to talk about something that we're going to allude to very heavily in the end of the second exam preparation. When we get to chapter 17 and chapter 18, this term will come up. It's called going concern. Has anybody heard that term before? Going concern? So going concern basically means that we are not certain, first of all, going concern itself means a good thing. If I'm a going concern a year from now, I've basically eaten right and exercised. Okay, that's my ambition, is to be a going concern for the foreseeable future. From an audit perspective, we generally consider going concern for a year-long perspective. If something is a going concern, we believe that it will be in business a year from now. If we have substantial doubt about an entity's ability to continue as a going concern, that is where we're thinking that their business model may lead them to not being in place for a year from now. Now, the reason that we talk about 5 years is 5 years we don't have any responsibility for disclosure in the audit report. We probably should talk about our concerns with the audit committee and talk about our concerns with management and say there does need to be progress in this area, but it's not going to affect your ability to continue next year. Year 6, you should still be fine. Then we have part B, which part B changes the scenario slightly. It says, would your answer change if the events occurred in the 7th year after the signing of the consent decree? That is where the answer comes. Yes, it would very much change our answer because this would affect the conduct of the audit and the opinion that we'd have to issue an audit report. Now, again, you don't need to know this specifically for the exam for right now, but I do think this is kind of an interesting implication for what we're going to be talking about later. Planning activities can affect what the course of the conduct of the audit moving forward, particularly with respect to issues that may become prominent over the next few years or are very important for the coming year. With respect to going concern, that going concern term is going to come up a lot in chapter 17 and 18 when we start talking about will the company be in business a year from now. All right, fun story. There was actually a time period fairly recently where a lot of organizations were kind of forced to issue a going concern statement in their audit reports. Can anybody guess what the time period of that was? Like when roughly within the past decade that might have occurred for prominently? 2020. What happened in 2020? COVID, yes, the pandemic. And so that actually created a lot of problems in that area. So, yep, something we'll allude to again here in the next few chapters. I say next few chapters. We got a lot of ways to go before we get there. We got an entire exam to finish before we get there. All right. I have not opened the document that I need to open, so let's get on it.
Yep.
Okay. So let's talk about what the quote unquote answer was to the materiality exercise that I had you go through. Now, did anybody go through this and say, this makes perfect sense? I feel completely comfortable with what I'm doing here. If you raise your hand, I would call you a liar. So, I'm glad that everybody left their hands down. So this is a very, very challenging activity because it takes quantitative items and says, let's apply subjectivity to them, which is really, really unnatural having to use both hemispheres of your brain. So let's talk about what some of the answers were and the rationale and reasoning behind these answers. Now, the first part is a little bit is pretty straightforward, though there is a little bit of a tilt here. So we talked about the measurement base, and we said the measurement base is going to be defaulting as pre-tax income. And you notice my answers here says pre-tax income is our measurement base. We kept that as case. Now, what was our criteria for using pre-tax income as our measurement base? A public or private profit-oriented company. This particular company, as we learned about in our review in chapter 3, this is a profit-oriented company that's publicly traded, so they meet that criteria. And we didn't have any of our caveats where we might change from our measurement base because there were issues, such as income being too low, or them being not for profit, or being an asset-based entity. So pre-tax income is kind of given. But you will notice that the percentage applies says 4.5%. 4.5%. So that's a little bit of a kick. Did anybody use 4.5%? If you did, I'm going to ask, where'd you get the solution manual? So, yeah. Actually, nobody raised their hand because they don't want to admit they have the solutions manual. If you have the solutions manual, just keep it under wraps, okay? Don't tell anybody. Anyway, 4.5%. So what is the logic between 4.5? First of all, if you used 5%, that's perfectly fine. I would accept that as a reasonable answer on the exam. But why did we say 4.5% here? What's the logic behind this? The answer to be this is that I don't know really. They talk a little bit about it down here in their answer, okay? And it has to do with, oops, this 2019, and that's a problem with copy paste. It said 2019. Actually, we're talking about 2024 and 2025. There's a long reason why it says 2018 and 2019. That's not the publisher's issue. That's my fault. But I'm not going to get into that one right now. Anyway, so 2024, 2025, there was a comparison here. So let's take a look at that. Look at pre-tax income for the previous year. So it's half of what it is for the current year. So what does that mean about the materiality that would be assessed for the previous year if we use the same rule? it would have been half as well. And I think that the 4.5%, in fact, I know it is, but it's kind of a simplifying assertion. Basically, the reason that they say that they use 4.5% is they wanted to make materiality a little bit closer in line with what was used in previous periods, because using twice the amount would lead to big skews in what was material and what was not. So they adjusted it by 0.5%. Logically speaking, that probably should have been a bigger adjustment, but again, that's one of those things that we hadn't talked about. It does make a little bit of rational sense when we think about it, though. The bottom line here is if I asked you to replicate this on the exam, I would not ask you to consider what the previous period's income is unless it was volatile. Did anybody catch that, by the way, in reading the Wilson Adams guidelines, the term volatile coming up? So the term volatility came up. What did they say about volatility? So volatility basically means that income is yo-yoing from being profitable to being positive to negative to positive, okay? Is that what was happening in this particular situation? No, so it was not volatile income, which was a really important criteria for actually being able to use pre-tax income as our basis. I would expect you to know that, but I wouldn't expect you to make comparisons here saying, I think shaving a 0.5% off is reasonable. If you did it, great. If you didn't do it, that's also great. So I'm going to use 3.15 million as my, or 1.6 million as my planning materiality. I'm guessing you used a different number, and that's perfectly fine. So let's go ahead and talk a little bit about some of the numbers that were assigned. Again, these are somewhat arbitrary. You'll notice that the answers don't even have the numbers that I used when we talked about this on Monday. I think I said 300,000 for cash, and it says 400,000 in there. Cash is not expected to have misstatements, typically not difficult to audit. Accounts receivable, so basically are very, very minor, and there's small amounts. There's some ones that I want to talk about that I think are important and relevant here. So if you'll notice, there's a couple that are very interesting. So intangibles. Intangibles does not use a very large amount, and it's not a large account. But did anybody notice anything about intangibles that kind of stood out to them? First of all, how many people in this room just feel really comfortable with intangibles, the philosophy and understanding? How many people are basically Dr. Ison? Dr. Ison loves intangibles. I think it's because it starts with the letter I. But yeah, he loves talking about intangibles. But intangibles are not real assets, and I'll fight to the death on that. Yeah, I will die on that hill. But intangibles, not really easy to understand, kind of complex and kind of challenging, but these are not large accounts. There is a little bit of a caveat to that, though. Intangibles in the previous period were 423,000 and they jumped to 1.7 million. So even though it's not a material account, it's not a large account, it's still kind of a surprising jump, which probably means that we have to have some emphasis. Now, $300,000 for material or for tolerable misstatement is more than reasonable. That's like 17% of the balance, almost 20% of the balance. So we are allocating quite a bit of room to that. That being said, it largely is defined by the fact that these are it's a challenging area to audit, and it experienced a pretty big change from the previous period. Yeah, as far as the rest, there's a few things I want to note. There's one thing I want to note up here for accumulated depreciation and amortization. Now, I don't know what your assignment to this one is. It looks like we're using about 50% of materiality for the answer given here. I'm guessing that you probably used a pretty large number here because it's a large account, okay? But if you look at the answer over here, it talks a little bit about something that we're going to allude to in the future. It says it's an accounting estimate tested largely via substantive analytical procedure. Now, what do we mean by depreciation being an accounting estimate? So how do you all do depreciation? How'd you learn back in your financial accounting classes? You basically said, oh, well, that's like straight line or units of production or some of the year's digits, something like double declining balance, all those crazy things. Do those exactly represent what the depreciation is? Like when you produce a unit and you take off $1 depreciation from the reduction of that unit, does that mean that particular piece of or particular asset has lost exactly $1 of value? No, it's an estimate that we're trying to determine what we think the loss of value is, not what the exact loss of value is. And so a lot of times in accounting, when we talk about things that are subjective of this nature, we're trying to make a good estimate or an estimation of what we think the value should be. The resolved value or what it is, the actual value is kind of beyond us. So we're trying to make an estimate. One thing we're going to notice when we get to chapter 5 is we're going to develop these things called substantive procedures or substantive analytical procedures. This is going to relate very heavily to what we're going to be doing for the Excel activity in this course. And basically it uses estimates as a means of trying to determine what we think the account balances should be. Now, the question comes up, if I asked you to conduct a depreciation activity, like I gave you a set of assets, I gave you all the information on the assets, I gave you a residual value, I gave you your useful life, and I gave you what the current asset value is. Could you calculate depreciation for a period for me? If I told you the method as well, I guess I probably should say. I'm not literally trying to exclude information. I'm just trying to remember everything that goes into depreciation. It's been a while. Could you calculate depreciation for me? Hopefully everybody's head is nodding. It's like saying, well, I took 302 and 303. I feel pretty comfortable about that. I'm not even going to do a complex one. We'll just say straight line method. Could you do straight line depreciation for me? Yes. Could you do makers for me? Of course, because you're taking tax, and tax people are crazy. You can tell Dr. Creighton has said that. Anyway, so yeah, that should be something that's certainly possible and conceivable to do. So that's something that we can employ as auditors in our tool and our arsenal for being able to make estimates. So what was your goal here? To assign these misstatements to justify your reasons for the tolerable misstatement. And then what did I say we needed to do? We had to get as close as we could to 4 without going over. Now, question comes up. Dr. Barnes, I was very efficient. I got to 2.8. I got to 2.8. I'm very proud of myself. All right. Should you be proud of yourself if you got to 2.8? No, what was my instruction? Is trying to get as close to 4 without going over. But what is the logic behind that? So what have we talked about before? We talked about larger amount of materiality means more or less work for us as auditors. Less. The larger materiality is, the less work we have to do as auditors. If you set this at 2.8, you were leaving like a few $1,000,000 on the table, a few $1,000,000 of assigned materiality, which means that the person who had to do the work as a result of your estimate is going to have to do more or less work. More. Now, how many in this room are going to be happy doing more work? Some of you may get to utility from doing additional labors, okay? And if you're one of those people, well, kudos to you, all right? But most people, I'm going to assume, are going to say, if I have the option of doing less work or more work and achieving the same result, I'm going to do less work, okay? That is why we were trying to get to 4, as close as we could to 4. This is setting the template for the work that we're going to have to do over the course of the audit. If we set this number too low, it means more work for us. If we set it high enough, but not go over, means we're doing the minimal amount of work we have to do and still gain reasonable assurance. That is the whole goal here. That is the whole objective of this particular activity. Does that make sense? Good, because I really don't have anything else to say. We're going to call it good here. We're going to start chapter 4 on Friday. See you then.